Yes. I see you're all back. I hope you enjoyed the coffee and the cakes. We're now heading for the first main stage session. And I would like to introduce two persons who do the main stage presentation. That's first of all, Ruth Wandhöver, German, professor at the Bayes Business School on new business models for the digital future. She wrote a couple of books on it. But moreover, she's also one of the women in the FinTech Power List, so that's promising. A second presenter is Thomas Otendaal, CFO at Ubix. And Ubix is currently building an institutional-grade stablecoin clearing, so that's very interesting. And they're going to discuss, both of them, on the financial transformation in the age of disruption. Again, disruption. The stage is now to Ruth and Thomas. Where are they? Yeah.
Right.
Well.
Welcome. Thank you so much for coming back from the cakes. My name is Ruth. Very brief introduction in addition to what we heard. I do teach at uni, but I also work in cybersecurity, which was one of the big topics we actually discussed at the very end of the last session. I would say that's probably the biggest risk anybody faces at the moment. And I've been in payments, treasury, and digital for 23 years, working at banks, regulators, and businesses. So it's great to be here with you. Thomas, maybe a few words?
Thank you for having me here today. I come from Treasury. I've been in Treasury for 25 years now. Corporate treasuries, bank treasuries. The last company, Ubix, where I'm part of the founding team, is actually trying to solve some of the new stuff happening, all the disruptions we're going to talk about now, which is the adoption of stablecoins and wallets, and how we create a clearing and settlement system to reduce risk and fees. But we will start talking about stablecoins, tokenized deposits, maybe a little bit of CBDCs, and the underlying infrastructure, and some AI on top, maybe.
Yeah, it'll be very informative. So I think we want to start with a few polling questions, which should come up online now.
I think you have to go into your app,
click
on our session, and then there is...
Thank you. And I have a clicker. Here we go. Oh, there we go.
A polling question coming up.
So we give you a few moments to answer, but the idea here is to obviously understand a little bit what you see as the biggest hurdle to changing treasury management. So obviously regulation is key. Technology has been absolutely changing the world in the last few years. AI, one of them being also a particular one, or any other things that you feel are more important.
We will have more polling questions later to see if we actually manage to
convince you otherwise,
to
or
plant
at least
a seed
enlighten
or two.
You. Yeah, that's right. Infrastructure is a big one. Here we go. So let's see what we got. Oh, infrastructure is the big one.
That's
excellent.
Good.
That's exactly what I was hoping for.
Me too.
Yeah. Regulation is always coming a bit late. AI is not yet, as we said earlier, maybe something for next year for sure. So technology change and the underlying infrastructure enabling potentially new asset classes or new ways of sharing value. Okay, so maybe I think we're good on this one. Mm-hmm. Then we have another polling question, which is all about the new kids on the block. How familiar are you with not only crypto, but stable coins, tokenized deposits? Oh,
that's the
no,
same.
that's this one, okay. What's the biggest hurdle of change? Presumably also technology, or maybe regulation. Regulation is a big headache for everybody often, in terms of reporting. So we'll see what we get out here. Okay, so regulation is certainly bigger, probably getting a little bit bigger. Hopefully not influencing any answers here.
Oh, that's good, Ruth. You were in Citibank running regulation in the old days, right?
Yeah, I ran all the regulation for Citigroup at the time in Treasury, and my goodness, that was right after the financial crisis, so there was a lot of change, but now we have lots of change too. Right, so let's move to the last... There should be the last question. And there we are now in terms of the new kids on the block. So how familiar are you with these new types of digital assets, whether these are stable coins, cryptocurrencies more generally, or central bank digital currencies? Which is really all about coding money into a different digital cloth and potentially, more importantly, programming it.
Yeah,
So
getting
you can-
away from the physical atoms they're made of and into code.
And
So
into
how does
quantum, maybe. Quantum.
interoperable
Quantum code.
between money, infrastructure, and risk appetites?
That's right. Okay, so we have at least a lot of awareness in the room. They heard about it, which is great. So that means we can now kick off the session. Thank you so much. Some good data for Xanders coming out of there. So yeah, we're going to kick off discussing a little bit the drivers of change here. So I'll flip to the first slide. Should I start with the national strategy, or do you want to start?
You can start. I want to.
Okay, so I guess one big piece that we need to keep in mind here is geopolitics, particularly in this day and age. We do see that both governments and central banks are looking at payment rails and the way their currency is being used and mobilized in the digital ecosystem as a very central point right now. Of course, you will all heard about Trump and his push into stablecoins, particularly with the recently published Genius Act. It's quite interesting to kind of just reflect briefly. Since 2001, the European Union had e-money legislation, which is sort of a bit like something you could do for stablecoin too. It's all about an issuer is taking in your money and giving you a different type of digital token and has to redeem it at par on request. And you can use this digital token in different particular technical ecosystems. Of course, for a few years, we already have the markets in crypto assets regulation in Europe. And the Genius Act is effectively catching up with the European legislative environment. But there's a particular piece here because, of course, US dollar stablecoins is US dollar denominated. It would help the US economy to somehow reduce their 37 plus billion budget deficit, which seems to be in the news every year at a certain time of year. But it is, of course, something that is important for global trade. US dollar is still the largest currency of global trade. And we do see the use of stablecoins in the cross-border context, particularly as an interesting tool to have a different way of exchanging value in a faster, potentially cheaper way. Maybe not so much for remittances, but certainly on the business side, there are real opportunities here. If I flip back just to the European side on the geopolitics, I recently came from the ECB legal conference where we discussed about the autonomy of the European Union, and there's a real focus by the ECB in terms of the whole European market around creating more autonomy, whether that is with the Wero wallet and the digital open banking account-to-account transactions, which are more retail, or of course with the initiatives that the ECB has on the digital euro, which is going to come. So just to give you a little bit two perspectives of geopolitical drivers and how jurisdictions are currently discussing the question whether rule of law still exists or it doesn't, which plays into these discussions for sure.
That's true, but I think actually the US has moved ahead with the Genius Act half a year ago, 8 months ago, ahead of Europe. It's been more applicable to businesses and certainly for retail. You see a lot of remittances in the stablecoin market right now, going from primarily the US into LATAM to Africa, and we actually have around 250 billion outstanding, $250 billion outstanding on stablecoins globally. So, and for us here in Europe, it hasn't really been an issue because we have plenty of dollar funding, we have plenty of euro funding, but in other countries it has been a problem. Fees have been high, counterparty risk have been high, so they're looking for other sorts of solutions that can help them in their everyday life, retail clients and underbanked businesses. I want to dive a little bit into stablecoins because I think we need to, just like when you play Monopoly, you need to understand the rules before you start playing. And before we dive into the national funding strategy and how banks are going to interact and corporate treasurers are going to interact, you need to understand stablecoins. And it's basically the same as a traveler's check. It's issued by a non-bank institution, is fully collateralized, it's a bearer instrument, it is negotiable, and So I guess some of you in this room have used traveler's check going on Interrail to Greece and Italy in the old days, and you know exactly what I'm talking about. And it's actually a very interesting tool because you would go abroad and every bank will clap in their hands, or money bureau or whatever, where you would go and cash it in would clap in their hands because they would be able to earn fees on exchange in this stablecoin. Traveler's check. And you see the same today. You would see the same if you created regulated issuers that could issue a stablecoin. You would also see receiving institutions around the world sit and clap in their hands when they would get a dollar stablecoin, because for them it's an FX fee they would earn converting the stablecoins back to fiat money. So I don't think we see a big difference in terms of use between traveler's checks and stablecoins. And like traveler's checks, you would also, and checks in general, you would have a clearing and settlement system, which UBIX also is building. That's a different story we can talk about afterwards. But in the check clearing system today, you would not. The reason why you have a check clearing system today is actually because there's too many connections in the world to connect an issuer and a receiver of a check. So, you know, it scales quadratically like A times B, where if you have a clearing system, the amount of connections is A plus B. So that is the reason for a clearing system on top of actually having a lower counterparty risk and lower fees. So that's stablecoin in a nutshell. Why is it then important for the national strategy? And that is because they have to be backed by fiat currency or government debt, as we know it today, HQLA debt. Mm-hmm. And anybody who issues a dollar stablecoin would have to have a US Treasury as collateral. The US Treasury is, of course, happy to do that. So when we talk about Europe also wanting an autonomous payment system, it's about Europe actually starting to follow the US and allowing European corporates to hold wallet addresses inside the banks as hosted wallets. You want to have all the stable coins and assets coming into the already regulated financial systems. The central banks and regulators like that. But then when you have stablecoins inside the system, Europe can issue euro-denominated stablecoins with euro-denominated debt as collateral and use that as a trade mechanism out in the world. So I think it's a gift. The Americans are sending stablecoins here for the banks because they earn FX, but it would also be a gift for the Europeans to start issuing European-based stablecoins, because then the governments in Europe can start issuing debt and send that out into the world as a diversified strategy. The US right now sends $1 trillion worth of treasuries to China. That might stop at some point, and therefore it's nice for them to have like a retail, wholesale funded national debt strategy, and the same for Europe should be the case.
Yeah, I think the debt issuance is a really important piece, because of course the European Union is always talking about its own budget. So it's all about how you deploy new technology in your overall business model as a country, as a central bank, and as a business. And I think this is where, when we talk about aspects like wallets and the whole data piece, we're starting to really see the benefits coming up. If you think about stable coins until today, very often they were not very well regulated. Genius Act is, of course, now coming in. So, of course, we do see wallets outside the financial system, digital wallets. We see stable coins often not regulated or very little regulated. Supervision is a problem. And in fact, you have some stablecoin issues over time where the US was not very happy that certain stablecoin issuers was holding so many treasuries. And so there are some issues that are now going to be likely to be resolved with the Genius Act, because you have proper supervision, and stablecoin issuers will have to follow very strict rules on redemption rights and risk management, etc. But you need to get to this point, and you start to see that the US will have the regime, the Europeans have a regime that they may need to amend and improve, but that means that we're starting to see also potentially other larger currencies following suit. And this is a slightly different variation to a central bank digital currency, which is a longer-term project that requires a little bit more thinking and input, because here we talk about, of course, the asset class of central bank money, versus a stablecoin, which is a hybrid asset class, versus maybe a tokenized commercial bank deposit, which is, of course, a commercial bank risk that you're taking. So just on the stablecoins to close, maybe around the relevance of legislation. Under tax law, these things will have to be very carefully examined. Under IRS in the US, stablecoins are actually property, which incurs capital gains tax. So there's something that still has to maybe be developed over time in the US regulatory regime.
We are trying to get it into becoming cash equivalent.
Exactly.
One day.
Cash equivalent is what Genius Act says, but unfortunately the IRS didn't care too much about it just yet. I think there are questions around legal tender, which become important. There are questions around actual settlement finality in those new asset classes and infrastructures, which is why we need to rebuild financial market infrastructure with the rules around it, because what you want for large amounts is, of course, settlement finality and not necessarily just counterparty risk and commercial risk on your counterparties and issuers. And of course, we have also at the moment no refund capability. It is final. So there need to be other type of dispute resolution mechanisms to ensure that these things can work through. Identity is a key piece. We have it on the slide in terms of legal entity identifiers as much as individual identity, EU IDAS and other regimes. And what I do consistently see is that many jurisdictions are still grappling with the identity piece. If you don't have a resilient digital identity that is also cyber resilient, which is really important, you're sort of missing the puzzle, because we talked about sanctions earlier. I know sanctions is a really big piece for Treasury. So linking the right identity in a resilient way to your financial flows is obviously critical.
I want to go, so as a treasurer, I want to go back to some practical examples. So I know we're in the beginning of, so first stablecoin, tokenized deposits, CBDCs, they're kind of a little bit the same. They're different collateral, different issuers, but they have the same purpose. But
same purpose,
so,
yeah.
But for a treasurer, a stablecoin issued by a regulated issuer with the right collateral behind we're currently in a state right now, as we were in the mid-90s, when American Online, AOL, and CompuServe and all these guys trying to build the internet themselves, and in their own little bubble, and they couldn't really extrapolate how the real internet would look like. I think we're a little bit in the same place right now before we clearly understand what stablecoins and tokenized deposit will actually do to finance. But imagine, today you have a company called Circle that issues a lot of, and Tether that issues a lot of the stablecoins, probably 95% of them all. But imagine you would have companies like American Express. They have brand, they have loyalty, they can give you credit, based on, they will give you credit and you can send $1 around the world. Circle and Tether cannot do these things. You would also have Amazon that sells $350 billion worth of goods, where 300 billion of those goods come from China. These Chinese producers, they would love to have dollars, and they would love to take US stablecoins and hold them, even an Amazon-issued stablecoin for them to be able to manage their suppliers. So I think we will see a revolution coming really soon, because there is a lot of fees to be earned for the corporates, and there's a lot of fees to be earned for the banks. There's a lot of debt to be issued by the governments, and then there is a lot of opportunities for corporate treasurers to move money around faster around the world, or value around the world. One of the key points to do that is actually not only the stablecoin, it's the wallet infrastructure. So a digital wallet is also a piece of software, but it's a piece of software that holds your assets where you can see them. It's a multidimensional account. Today you have a bank account that holds euros, only holds euros, can't hold anything else. A wallet can hold all sorts of asset classes, so tokenized treasuries, it can hold tokenized dollars, tokenized euros, tokenized pounds, everything in one wallet, which means that you can significantly reduce your amount of accounts from, right now I'm speaking to a big Dutch company that has 3,000 accounts across more than 50 countries. And they will be able to come down to about 100 wallets, and the reason why they can't go lower than that is obviously because they have 50 legal entities around the world, so they need to have, a little bit of wallet in each. But imagine having all those assets sitting inside this wallet, so you can do your not only cash management, but also liquidity management, asset management, collateral management, maybe capital management or real estate management within the same wallet. That brings a whole new spectrum to
I think, Thomas, you're making two important points. I think the first is that whilst years ago you might remember the Libra initiative got closed down by the regulators that really tried to do almost their own stablecoins, you could argue, right? It was a conglomerate of different corporations that wanted money for their network and anybody spending it in that network. We now moved ahead with digitization in such a way that you will start to see Amazons and others thinking about actually doing that. If an Amazon does it, it will be a very, very big deal. Of course, the question is then acceptance, fungibility. This is really why the BIS today says a stablecoin does not fall into the definition of money, because it doesn't necessarily have ubiquitous acceptance. But if we get to very large players with very recognized, highly liquid currencies that are, of course, treasury-backed fully and regulated in terms of these providers being regulated, not only do we start to see that actual businesses become financial service providers, and we discussed this many years ago, but now it's starting to happen, but we also create the fungibility that is critical and the acceptance to actually do so. And I think on the second point, the wallet piece, we're going to talk about this in more detail in a second, is really about having that digital layer of data. Money is just data. Before it was electronic, which was already data. Now we have a different form of data, but it's still data. And as soon as you start to take this mindset shift and really accept it, and central banks are looking at it, they're looking at programmable money, they're looking at creating ledger-based infrastructures where maybe 2 years ago they said, no, it has to be a centralized infrastructure. So we're starting to get into decentralization, and we're starting to see the opportunity of digitization across the board. I'll flip to the next slide because we're already a little bit in that conversation. But I think these are the two key trends. You have businesses becoming financial institutions, and you have actual digitization of the whole process that gives you the insight for efficient liquidity and risk management, which is, of course, critical.
But I have a question for you, Ruth. So I know we're supposed not to talk too much about central bank digital currencies, because there will be an excellent session later. But where I come from, stablecoins, tokenized deposits, CBDCs, they're kind of a little bit interchangeable in terms of a clearing and settlement system. But why would you use a CBDC instead of a tokenized deposit and a stablecoin? I think, it's like you use Gmail, right? You don't use a government-issued mail server, right? Because private-issued technologies are kind of, they're usually more...
Let me give you another, so I can definitely answer that question. So I guess we have to zoom back a little bit around the origin of central bank digital currencies, which came from Libra, they came from Bitcoin, and the concerns of central bank that there's too much monetary flow outside of their control. Mm-hmm. And that's absolutely acceptable. But here we're talking about institutionalizing those innovations for corporate treasury, for banks to actually engage in this ecosystem in a regulated and efficient way. And there we have a completely different conversation. And even the ECB moved on from that, because actually they are now saying this is a backup resiliency play. If other systems, Visa, MasterCard, fall down, if the Euro wallet may fall down, open banking, if there's some issues, we will have a backup of a CBDC, which is in the European Union certainly discussed as a retail CBDC. So we're not talking about wholesale payments. The corporate agenda is already outside the picture in that sense. We have seen, of course, the US stepping back from any CBDC conversations. We do see countries like the UAE with the digital dirham issuing a CBDC in future. They've already set up the regulatory system, their technology, and they're ready to go. And this is a different form. So this would be central bank money, liability on the central bank, which tends to be only used in settlement when we think about corporate flow, right? So we are really in the world of commercial bank money here. And if you have a well-regulated stablecoin, in addition to your tokenized deposit, you can almost say it's the same. And therefore, I would say that in future, in terms of treasury, tokenized deposits of banks, commercial bank money, as much as a stablecoin issued by a stablecoin issuer against fiat money, commercial bank money, highly regulated, are interchangeable from a risk perspective. And then it's really, as you say, it's about having the wallet infrastructure to aggregate all these data points to know where your money is and which underlying fiat currencies it's pegged to. And that's really your currency risk. And you may end up optimizing to such an extent that you end up working really in very few currencies, where maybe, as you say, I mean, we do know that businesses and individuals in some difficult emerging countries that have high volatility of currency, of course, prefer to get a US dollar. It might not be the interest of their central bank, so you have also political conflict with BRICS and how they see their own central bank digital currency agendas versus maybe what the businesses think. But I would say from a functionality perspective, corporate treasury could certainly see a concentration in high liquid currencies.
I think there's been a lot of talk theory and what are these different types of coins, but getting back to practicalities and the day-to-day life in treasury. So why haven't we used it in treasury yet? So today, if you receive a stablecoin into your wallet, you would have to go through exchanges like Bitpanda, Kraken, Coinbase to sell it. So it's more like a security kind of type of thing. So you would sell it at the current price at the exchange. Banks obviously can't do that because there's a lot of counterparty risk towards the exchange, but there will also be a lot of high fees, so it will be prohibitive for them to kind of engage. So what is needed is actually a market infrastructure that is what we have had previously. When you clear your euros or clear your dollars, you have your clearing systems. And since stablecoins and tokenized deposits are hopefully soon becoming more cash equivalent, so they actually show up as cash on your balance sheet and not as an intangible asset, you would actually be able to put your stablecoins in for clearing into the system and getting your euros or dollars out the other way, while the issuer of the stablecoin gets their stablecoin back again. Once you have that, your counterparty risk will fall to basically zero rate risk, and you would have certainty that you would have your par value back because the issuer will have pre-funded accounts, or even other types of collateral sitting as with the custodians and the settlement banks, just like you know it today in your collateral management processes. We believe at UBEX when this is up and running later in the year, that banks across the world will start allowing their corporate clients and retail clients to open up wallet addresses, so they, just like checks, can receive from, if they're merchants, can receive from their clients or other types of flow into the wallets, and then the bank on behalf of the clients will redeem them directly with the issuers and credit the dollars or euros or whatever is needed, making the fees. So the processes will be the same. It will be more efficient. There will be more rich data layers to reap, and I think that goes into our next discussions, which is probably around programmability and how to use this going forward with AI. I know the first steps is actually being able to receive stablecoins, but once you have learned that and you know what type of data you get in, you would be able to use AI to optimize not only the yield on your portfolio, but also your counterparty risk or country risk or whatever types of risk you would have been sitting in the wallets. It will increase probably your treasury profits while decreasing your risks, your capital requirements, and your operational costs significantly.
Yeah, so maybe just for the audience to sum up a little bit the wallet conversation, we do expect a future infrastructure where digital wallets are actually given to you by your banks. So this is not something that you buy on the wild west of the internet in terms of what we see with some of the crypto offerings today. And these wallets will really function as your data hub to optimize, as you say, your liquidity, but also to code in your risk management, your risk appetite, and to see your exposures across different jurisdictions. Yes, you will have several wallets because you will have several banks in different markets, but you are able to really aggregate those thousands of bank accounts with all their statements, and even though they're digital, they're never really that automated and fully visible, into less hubs of data that you can then do like almost an Uber wallet aggregation play, which is really what we would call intraday or 24/7 hour liquidity management that we are still missing sometimes in banks, but we would see it at a corporate treasury level because you would have a nice HUD display of all your digital wallets with all your assets in there. And then on the second and third layer, you can start programming and basically shifting assets. If certain exposures are too high, if certain currencies fluctuate in certain ways, you can program all of that in. And that is really true digitization of the financial infrastructure and value chain. And I think this is what we're truly seeing as becoming possible in the next few years. Yes, there are clarities that we need on regulation and tax treatments and things like that, but the banking industry is also engaging in this. And so I think what we want to make sure is that you're empowered to have those conversations with your bank partners, because some banks may be more engaged than others. And as Thomas pointed out, things like clearing, which we have, of course, in payments, clearing and settlement are critical. Clearing will happen in those new digital asset infrastructures with UBICs, but also with other large clearing houses that may take over and say we will expand our abilities. And the same happens, we see it even with trading, right? We know that stock exchanges are looking at digital asset trading, or they're already offering it. And I think this is where the whole conversation is really going into digital end-to-end value chain, securities and cash.
I usually give an example. So as a treasurer, bank treasurer in the last 10 years, been managing the bond portfolio. And I spent, since 2016, also looking at digital asset strategies and how to actually, use that more. So one of the examples I used to kind of convince my board, which didn't happen, but was that, there's $150 trillion of fixed income in the world. Maybe $100 trillion of those are relatively, structured in EMTN programs and government debt and stuff like that. So they have an average duration of 7 years. So I don't believe that any of these bonds are going to be issued as in a traditional way in 7 years. So when they have to be rolled over next time, it will be as a tokenized asset. Yeah. So I think when you talk to some of these consultancy companies and they say, well, we had $10 trillion or $20 trillion in 2035, I think they're completely wrong. This is going to go really, really fast because regulation is coming, and there is an insane economic incentive to adopt this. So having said that, I also think that we need more businesses. The banks, they have an economic incentive to enter this. They already can see the FX fees of trading this and converting the stablecoins into different types of money. But for the corporate treasurers, we need them to join, go and tell their banks that we would like to have wallets and start experimenting with this. We're actually at UBEX today doing pilots with the PSPs and corporates, wallet providers, blockchain analytics companies, asset analytics companies, compliance companies, around how can we actually build an infrastructure around a clearing and settlement system, so you feel comfortable, the banks feel comfortable, the regulators feel comfortable, and you actually can see how you can monetize this compared to how you do it today. Yeah. So if anybody want to join that, DM me or catch me outside for the rest of the day.
And I think one of the things that we didn't mention too much is obviously cyber resilience, because all of those digital infrastructures are vulnerable if you don't set them up in the right way. I just wanted to throw in the AI anecdote on Replit, which recently was an AI tool that actually deleted a whole production database in a company and then lied about it. So we also have issues today, which are all teething problems, and they're all part of the ecosystem, because you cannot have a digital future without digital resilience, so cybersecurity is critical. I would like to move to the last two polling questions briefly, because we're starting to run out of time. Yeah. So get your handsets out and get some polling onto the screen. Thank you. Right. Is anybody working with stablecoins now that we talked about this?
Does it say how many? No.
It's going to come. It's going to when they have the result. Okay. So no. Right. That's a resounding no. Well, maybe that will change. At least be curious about it. That's critical. Okay, and let's go to the last one. I think we had a last question there. Oh, yeah. What's the biggest adoption blocker? I guess, not that you're not working with it, but what are you most concerned about, I guess? Regulation, infrastructure, bank involvement, risk, or just the understanding about it?
Yeah, I guess so. For many treasurers, it's about what product and service does the bank actually offer, right? It's driven from the bank side, which is understandable because the banks they have a license to operate, right? So they need to defend that and can't go into it before.
It's a perfect bank corporate collaboration topic, actually, which is of course the whole idea.
And knowledge as well.
Yeah.
Well, knowledge we can do something about. We actually have a wallet. I have a wallet article coming out that explains for corporate treasurers how this is going to happen. I think we will also be working with centers on some education here going forward. So I think there's a good chance that we will be hearing more about this in the near future.
Now I do have 2 minutes and 17 seconds for audience questions. I will very briefly throw. Anybody here on this side that has a question? Don't tell me you don't have any questions. I'm just going to throw it in, and then you're going to have to take it. There's one behind you that really wants to ask a question. So give him the thing, because he has to speak through it. It's a speaking tool, Go.
This is an interesting microphone. So you mentioned once clearing becomes operated by banks, basically there's no credit risk left. But how do you concern credit risk towards the issuer? Because, for example, I'm not very comfortable having large exposure to Circle as a company. Is this something you can elaborate a bit on?
I didn't get that.
So you mean the counterparty risk on the issuer of the stablecoin?
Yeah. If you have a wallet with, I don't know how many millions of USDC on there, or USC, whatever you want.
So in a clearing and set, just like you have Visa and MasterCard today, they also kind of solve a many-to-many problem with the issuers and acceptance. A clearing system will have a rule book like Visa and MasterCard. So in order for you to actually be a member of the clearing and settlement system as an issuer, you need to comply with certain rules. Some of the rules could be a rating, for example. We see today that both Moody's and S&P are rating stablecoins and stablecoin issuers, just like they do with traditional fixed income issuers. And so there could be some minimum ratings, let's say single A or triple B or something like that, and everything above would be eligible. But it's more important on the receiving side. So the banks who offer, if ING offers you wallet addresses where you can receive stablecoins in, it's up to ING and you to decide which of the stablecoins that are part of the clearing system that you can actually receive. You don't have to receive everything. You can simply close off all of the stuff you don't want to receive, and maybe only receive the 3 ones that you have actually actively selected into your wallet address. That's the smart thing about wallets, that you can program you out of this. And you will also have obviously all the asset analytics tools and stuff to support.
I mean, maybe just to complement, clearing will happen in future in the same way it happens today. Yeah. These will be regulated infrastructures. They will have rules as to which issuers of stablecoin can actually perform on their platform, and you're taking away the many-to-many risk and concentrating it into a counterparty risk with the clearinghouse, basically, right? Which is, of course, why in the aggregate large sense we have rules for clearinghouses and resolution and recovery rules. This is obviously a path of time, but you will expect to have clearinghouses concentrate and manage that risk and have also these risk mitigants in place, and therefore you don't have a direct exposure to the stablecoin. We're running out of time. It even says overtime.
It's overtime.
I don't want to get into trouble with the Dutch people. Maybe one more question? Here we go.
Last one.
Last one.
Patrick Peters from Saudi Arabia, PIF. One question. Wouldn't it be much more efficient if what you're doing with UBEX becomes a public common domain rail towards settling wallet settlements, rather than each company setting up their own and then trying to compete who gets the critical mass? Would you foresee that at a certain moment you would be taken over and be something common like SWIFT was in the past?
Yeah, so we are creating the message layer between the custodians and the settlement banks. we are an independent provider. But for corporates and banks, they have resiliency strategies, so they need more clearing and settlement providers. We are completely open, for all issuers, for all receiving institutions. We don't have any limitations. The only thing we have is a rule book that defines what is needed to be part of the system. So we're also working on, because it's blockchain based, we work in the permissionless space, where we believe, just like American Online, we can't build like these closed systems. We need to have open systems that you can build applications on top of, and corporates and banks themselves can build on top of. So,
maybe to add, I think we will start to see different financial market infrastructures for a digital future. SWIFT is an interesting analogy because that's only a messaging network. What we were always missing is the actual asset transfer and settlement, because we don't have a global payment system. And this is why we will start to see clearing, but not yet settlement. And I think settlement will be important. Settlement will be a function of regulation. And there could even be cases where you start to clear a stablecoin and ultimately settle it in a central bank that has a digital assets settlement function, as much as Target 2 today has a euro electronic money settlement function. So this has to go hand in hand to make it resilient, and we are at the beginning.
Yeah. And so it will end up with the messaging layer and the settlement will happen at the same time, and not T+2, T+3.
And regulated for certainty. Yeah. So you will have finality, which is of course critical. Okay.
Thank you.
Thank you so much. Any questions, come to us later.